For our audience, can each of you, Dave and Doug, please offer a 5-minute snapshot, your vision of the current international economic landscape, and a short-term, 1 year or so view of what the trends or events will result from this. And if you can follow that with your view of how these trends will influence gold investors, perhaps explorers also and producers. We'll start there, 5 minutes each, and then time permitting, you may have other metals you'd like to also apply the same question to in the second half of the debate. We'll start with a 5-minute position statement from Dave. Dave is the geology side of Hard Rock Analyst Publications, and he's been active in prospecting, resource calculation, and feasibility studies for resource companies for 29 years. He has authored many qualifying reports and managed and designed many field programs. And in 2001, the Coffins defined the current cycle as the secular trend that others have only recently recognized. Doug Casey is chairman of Casey Research and a highly respected author, publisher, and professional investor. And he's been featured on hundreds of radio and TV shows, including David Letterman, Merv Griffin, Charlie Rose, Phil Donahue, NBC News, etc. Doug is known as one of the preeminent authorities on rational speculation, especially in the natural resources sector. So if you'd like to start off, Dave.
Thank you, Diane. I think, in terms of the introduction, that's maybe a good place to start. I don't think we could still say we're late in the market recognizing that we're in a secular market. What we are in is a point where people are questioning whether that continues or not. We are still very much in the throes of the financial crisis that was created by the housing and debt markets in the West, and we have reached a point of consolidation in the early going of that mess, really. The question is, how forward from here? The West, the U.S. in particular, but certainly also Europe, will have to be paying down debt for some years to come. The bubbles that formed in the housing market will take another 5-6 years to finish. At the same time, a movement that had been started in East Asia, in China in particular, in South Asia, and in other places like Brazil, has continued. Now, I think the biggest question mark for most people is whether China can continue to grow while the West is stagnating. My answer is yes. What's been going on in China is not purely an export-driven phenomena. Every growth spurt in industrialization from the time that Amsterdam first started to fund the British has included an import-export component early on. They all have also reached a point where the internal mechanisms of the economy, high savings, generate internal growth. I believe China's reached that point. It will not move as fast as it has in the past. It will certainly be volatile. India is coming on behind it. Other large in terms of population economies are also building. It will not be nearly as easy to move things along when you have the largest economy in the world, the USA, and the second largest, Japan, and the third largest, Europe, having problems. But already China, by some numbers, has eclipsed the latter two and has moved into second place, and I don't see any reason why it shouldn't be able to continue. My take from that is that, on the one hand, the world is looking for some areas of comfort. They're looking at the metal sector in a broader sense, but most particularly they're looking at gold. And the reason they're looking at gold is it does have a historic role as a monetary medium. It's recognized as neutral, and for those who dig a little deeper, the underlying fundamentals say that at $1,200 US per ounce, you are just at a point where you can bring on a continued mine supply at current levels, so long as demand continues to pick up, and I believe it will at an investment level. The old maxim of holding, depending on who you listen to, anywhere from 3 to 10% of your portfolio in gold has taken hold again. That is continuing, and it's going to continue to influence the price of gold. I believe that the gold price will continue to rise steadily in US dollar terms, and that has already taken a hold as a gold boom within the market. By that I mean, even on days when the gold price is consolidating from a short run move, you see continued buying in not only senior stocks, but junior stocks as well. I also believe that the senior producers have reached the point, after a decade of dealing with it, that they've paid down debt, that their bottom lines will grow even without a large growth in the product they produce. The same thing happened with base metal producers earlier in the last decade. That's where we're at with gold, which is good for everyone in the sector. I believe that the junior movement we're seeing now, the interest in evolving and expanding assets within the sector will continue. There is caution, and I think that the caution is best recognized by the fact that Canada, for the first time in 30 years, is at the forefront in this asset expansion. People are more comfortable moving into an established economy like Canada's, which seems to have weathered the storm fairly well. So that's my take on gold, and I think the gold price will continue to rise over the next 12 months. We'll see that continued expansion, and as importantly, we will see more people coming into the equity side of the gold picture. On base metals, I am much more selective. I do believe that there's a long-term supply excess that's being worked through in a number of metals, copper in particular I like. That will play up and down against what's going on in Asia, and most particularly in China. I think that cautiously a person can be in that part of the metal sector and do well. Certainly there are even a few juniors in that space that are continuing to rise. The caution is that if it looks like China's weakening, or other parts of the BRIC empire, or empire in building, are weakening, those prices could come down sharply. That's my basic take. That's how I see the next 12 months. I'll hand it over to Doug.
I agree with Dave. In fact, there's very little that I've ever disagreed with Dave on, except maybe what wine to have with dinner. But I've got to take that a bit further. Regarding the economy, I think that what we're in for now is not just another period of turbulence, but I think we're in for the most serious thing, not just since the last Depression, but actually the most serious thing since the Industrial Revolution. This is a major period of turmoil that we're just now entering upon, and it's got lots of implications for all sectors of the economy, and more than just the economy. It's got implications for that reach into politics, that reach into that are military, that are social. So this is more than just another recession that we're looking at. I call it the Greater Depression, the Depression being defined as a period of time when most people's standard of living drops significantly, and that's what's going to happen. Now, as far as what this means for the metals, well, let me give you a time frame for this. Right now we're in what I would consider to be the eye of the storm. We went through the leading edge of the hurricane starting in 2007, 2008. In between, these governments have idiotically thrown trillions of currency units, all of them. The Americans, the Europeans, the British, the Chinese have been among the worst offenders in this way, have thrown trillions of currency units at things, trying to maintain old patterns of production and consumption. So we're in the eye of the hurricane now, but I think within the next 12 months we're going to start coming out the other side. And the other side of the hurricane is going to be much more turbulent and last much longer and have very serious implications in all ways. Now, what's got to happen is that the world, which has been living way above its standard of living for many years, that's what all the debt in the world is about. When you borrow, you're taking production from the future and consuming it now. When you save, you're putting off that production to be used in the future. This huge amount of debt represents immense amount of consumption that's been taken from the future and consumed now. So the answer to the world's problems is to save, not to consume more, not to borrow more, not to spend more. It's to save more, which means to produce more than you consume. That's how you become wealthy. Now, what does this mean for the metals and for the mining markets? I'm not very bullish on the base metals. A lot of the spending that these governments are doing is going to go for infrastructure and so forth. That's going to use a lot of steel, a lot of copper, a lot of aluminum and nickel, so forth and so on. That may keep these levels higher than they should be. The other thing is that as these currencies start achieving their intrinsic value, which is basically zero because they're backed by nothing, I think there's going to be a wholesale panic into commodities because at least they're real wealth. All the commodities have value, and that's going to support the industrial commodities as well. But I'm not really very interested in owning them. What I am interested in owning is gold. It's the only financial asset that's not simultaneously somebody else's liability. You're finding central banks are going to be buying it. Individuals are going to be buying it. Everybody's going to be buying it. In real terms, it's going a lot higher from here. I think that this market's going to go into a mania stage where the price of gold could, at some point over the next few years, start tacking on $50 a day consistently, and silver will likely follow it too. And I think this augurs very well for the mining stocks in general, and hopefully the quality exploration stocks in particular. I hope that a mania is going to be ignited where these things just fly. In other words, the trillions of currency units that governments have been creating over the last few years is likely to create other bubbles, just like the stock bubble, the real estate bubble that they created in the past. It's likely to create a resource bubble and a gold bubble in the future, and that's likely to flow into this nano-cap area of stocks, the mining stocks, and there's an excellent chance that they're going to fly. So that's my view on the economy and gold and the metals in a nutshell. Dave, I don't know if you have any further answers on that.
Yeah, I think we've got a basic agreement there where we may differ. I think it might be in terms of what the requirement for the West to pay down debt means in terms of the growth economies. There's no question that for a decade, China was lending the U.S. economy its excess wealth or its excess wealth creation in order to stimulate a market for its exports. I believe that if they were wise, they would be doing less of that, and I think they're trying to, although they're still trying to sort out the best balance there. But I think the engine continues, the growth continues. There's going to be, and it's very important to keep watching for some turmoil within China itself, as is typical of this type of expansion through industrialization. There are wage disparities building. There are disparities between urban and rural. These are all quite real, but I think they can be sorted out. I think the Chinese government is trying to find that sweet spot that allows it to continue the growth, which requires inherently some democratization without giving up the ship in terms of who gets to be the captain. I think at the same time, what's going on in India, which is a much more measured, at least so far, growth, again, from a large pool of old money, if you will, is going to help stabilize that situation. I certainly wouldn't look to Russia to do that, maybe one decade. I think Brazil, which does have, from various sources, its own pool of stable wealth, can also help to do that.